Okay, thanks for joining us today. My name is Chloe Buck and I'm a BDM based in Perth. Unfortunately, Kim has a conflicting engagement, so she sends her apologies that she can't be here today. David has some great insights to share about Strata insurance affordability. While David is a brilliant actuary, he will only be talking about today's topic, so he won't be able to answer any questions regarding the current topics in the media. In the spirit of reconciliation, CHU acknowledges the traditional custodians of the land on which we live and work throughout Australia, and their continuing connection to land, sea, and community. We pay our respect to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples. I would like to introduce our presenter today. We have David Barnes, who is CHU's Head of Actuarial and Data, bringing over a decade of experience in general insurance. Throughout his career, David has held diverse actuarial roles, specializing in data analytics and pricing. His prior positions include Technical Data Manager at IAG and Price Setting Manager at QBE. David has been a fellow at the Institute of Actuaries of Australia since 2016. In 2020, he also undertook additional postgraduate studies in teaching, specializing in mathematics. If you have any questions, please play them into the chat and we will review them at the end, or we will get back to you after the webinar. Over to you, David.
Thank you for that introduction, Chloe, and good morning, everyone. So today we're going to be looking at affordability, and I've pulled together this slide to kick us off, just painting the picture of why we're here having an affordability conversation. Affordability has obviously been a big topic across not just strata insurance, but everything in the last year or so. I'm sure you've all been feeling that pain, both professionally and individually as well. We've had the federal budget handed down this year, was called the cost of living budget. We've had a couple of months ago an affordability task force announced for insurance with calls to introduce something similar to what's happening for ARPC cyclone, but to introduce that for other perils like flood as well. So very topical. But what I want to do today is be able to just around how affordable strata insurance actually is. I want to spend some time looking at where affordability is more challenging for strata insurance, and then I'll conclude by giving a few thoughts on how we can make sure that affordability is maintained and what we can do to address some of the challenges. So what I want to do is kick things off by getting your thoughts on strata insurance. And I've got this question for you. So imagine that you are an apartment owner. There should be a Zoom poll that's popping up on your screen now. What I want to know is, what is a reasonable amount for you to pay each year for your insurance? If you click on the radio button on the screen and hit submit, hopefully that will all work. And we'll get a picture of what everyone thinks is reasonable. Is it $0, 500 to 1,000, 1,000 to 1,500, 1,500 to 2,000, or over $2,000? Hopefully you're able to answer that poll, and we're starting to see some results coming through now. So I'm not sure if you can see the poll results on your screen, but there were 0 people that have voted for $0, which is good. That will keep me in a job a little bit longer. There's 28% of you saying 500 to 1,000, and the most common answer seems to be 1,000 to 1,500, which has just under 50% of respondents picking that number. So what you're thinking is it's reasonable to be paying $1,000 to $1,500 for strata insurance per lot. The next question I have is, how much do you think apartment owners are currently actually paying per lot? So reasonable for it to be 1,000 to 1,500. What do you think the number actually is at the moment? Is it 500 to 1,000, 1,000 to 1,500, 1,500 to 2,000, or over 2,000? Let me pull up the results of that poll now, and hopefully we'll see what people think. So a little bit more of a mix there, but 20% of you think that the current premium is 500 to 1,000. 36% are saying 1,000 to 1,500, and 31% 1,500 to 2,000, and just over 10% of you think that the current premium is over $2,000. I am seeing a couple of messages in the chat coming through suggesting there might be some audio challenges. I'm hoping that I've just adjusted my microphone, so hopefully you can hear me, but if you're still struggling to hear me, please post up in the chat and I will try and make sure that we can resolve that. But looking at this answer, most of you think it's reasonable. Sorry, most of you think that it's reasonable for $1,000 to $1,500, and the most common answer is that people are currently paying $1,000 to $1,500 as well. Now, the big reveal is that the current premium that Strata owners are actually paying averages out to be $954 per lot. So that's the average premium that an individual lot owner is paying is $954. Those graphs on the right-hand side are maps showing for each postcode in the major capitals around Australia what the average premium is. And you can see that average premium does vary a bit by location. So the color coding on those maps are gray is areas where the premium is less than $500 per lot, and red is areas where the premium is over 2,000 per lot, and the gray is just spots where there aren't a lot of strata buildings insured. So you can see that there's a fair bit of green quite consistently across all of the major regions where strata is sold. Can see if you look at the Sydney graph, there's a little bit of red, particularly in areas where you can see water of some kind, and much the same in Melbourne, where some of those more affluent postcodes tend to have higher value lots. That translates back to higher premiums per lot, but overall the average is 954, and whichever city you're in, there's a fair bit of green. So the distribution of premium is fairly well on the low side of the $1,000. So got a question for you now, which is what factors do you think would make a premium unaffordable? What I want to get at there is we might know that the average premium is $954, but how would you decide if $954 is affordable or unaffordable? If you can put some answers in the chat, then I'll read some of them out and we'll get a good sense of what might be driving affordability challenges. I'll just read some out as we go, but I've seen construction quality and maintenance, mortgage increases, weather conditions, cladding defects, elderly owners, claims history, outstanding maintenance and defects, claims has come up a few times, disposable income, cost of living, financial pressures, location, and increasing property prices, meaning there's less disposable income, flood zones. I think those are all really good points in terms of what can make premiums affordable or less affordable. And it's certainly true, especially in strata, that a particular premium number might even be affordable for some of the lot owners, but not affordable for other lot owners within the same building. So affordability is hard to put a single measure on, but I'm going to give it a go. And if I jump ahead to our next slide, what I want to introduce you to is the Australian Actuaries Home Insurance Affordability Index. So recognising that defining affordability of a premium is a challenging task, what the Actuaries Institute have done is spend quite a bit of time thinking about how we go about measuring and assessing affordability and what can we do to address some of the challenges with affordability in the insurance market. Last year, I co-authored a paper with the Actuaries Institute looking at flood insurance availability and affordability. And in conjunction with that, the Institute released a report produced by Finity that had this Australian Actuaries Home Insurance Affordability Index. So what they've attempted to do is to, as best as they can, summarize affordability pressure into one single number for a location. And that single number is based on income. Now, that was a point that was raised by a few of you on the previous slide, where disposable income informs affordability, or the amount that you're paying on your mortgage means you've got less left to pay for your insurance. The measure that they've used is affordability, because that does, the measure they've used is income, because that does inform capacity to pay for insurance. And specifically, they've come up with this metric, which is how many weeks of gross household income does it take to pay your insurance premium? So they've looked around Australia, they've used some data sets to get a sense of what income is in different locations. They've done the same to see what premiums are. And when they compare the two, they end up with this graph or this map of Australia on the right-hand side. So what that map is showing is the green and dark green, especially that those areas are the areas that are under what they've deemed either no pressure or low pressure. No pressure being where your premium costs you less than 1.1 weeks of income to pay for. And then on the other hand, you've got the red areas where they've described extreme pressure, and it's taking 4 or more weeks of gross income to pay for an insurance premium. So you can see those red pockets, they do pop up around Australia, but particularly in northern WA, northern Queensland, and the Northern Rivers region of New South Wales. That's where affordability challenges are most prevalent, but in aggregate around Australia, what they found was that 12% of households experience home insurance affordability stress. And that's corresponding to the red bands on the map where it's taking 4 or more weeks to pay for your premium. Now, what I want to present now is what that looks like for Strata, because this map has got some really good insight in it in terms of affordability and income profiles versus premium. But this map is showing affordability for home insurance as a whole. And home insurance does include Strata, but Strata just gets lumped in with all the standalone homes as well. And we know that Strata has quite a different geographic distribution for starters, but also Strata buildings tend to have different affordability challenges because the owners tend to have different income profiles, and the buildings tend to respond differently to weather events as well. So jump to the next slide. What I've got now is that same graph that same map that I just had up on the right, which is home insurance as a whole. And now on the left, I've got what that affordability index looks like just for Strata. So the most noticeable thing when you look at that map is that there's a huge amount of grey, and that grey is simply areas where Strata doesn't really exist. Either it exists and we just have very few policies there, so I don't have data for it, or for most of that, Strata just isn't offered in those areas because Strata is obviously concentrated in Metro. But if you do look a little bit closer and look past the fact that most of it is now blank, what you will notice is that the entire graph that is coloured is green. In other words, using that same metric of affordability and comparing premiums to income, doesn't really matter where you are in the country. The average affordability of Strata is taking either less than 1.1 weeks for a lot of places of income to pay for the premium, or where the premium affordability pressure is highest, it's still less than 1.8 weeks, which would put you into the low pressure band that the Actuaries Institute came up with. So I'll show you what that looks like for each of the major cities, because it makes for a more interesting map than just looking at Australia as a whole. So if we start with Sydney, for coming up with that index, the Strata index works out to be 0.5 weeks. That's based on an average weekly income for a household of $2,200 in Sydney, an average Strata premium of $1,114. So the premium divided by the income, and you get 0.5 weeks of income. And as you can see in that map, doesn't matter which postcode you're in Sydney, that affordability story is the same, where it's taking less than 1.1 weeks of income on average to pay for a Strata insurance premium. We jump to Melbourne, same calculation. The average Strata premium is now $918, so a little bit lower. Average weekly income is $1,887, and the affordability index also works out to be 0.5 weeks. For Brisbane, the average weekly income is just under $1,800. The average Strata premium is $946, and we get to that same number of 0.5 weeks of income. For Gold Coast, the average Strata premium is a little bit higher than the other regions that we've looked at so far, and that does lead to a worse affordability score, but it's still 0.8 weeks, which still sits firmly within the no pressure grouping that the Actuaries Institute has come up with. But there is a little bit of low pressure around Tweed Heads in the south. We go to Adelaide, both premiums and average weekly income drop down a little bit, but the average affordability index works out to be 0.6 weeks, and that story is the same across all of the postcodes where Strata is prevalent. In Perth, the affordability index is also 0.6 weeks, with an average premium of $968 compared to average income of $1,743. So to summarize that, doesn't matter which city I look at, all of the cities have affordability indexes that are well and truly in that no pressure banding of 0 to 1.1 weeks. That story is true not just for the city as a whole, but in each of the postcodes within the city, that average affordability still stands. So based on the Actuaries Institute definition, the affordability of Strata is quite good. And if we were to compare that to home insurance, this table shows you on the left-hand side what the affordability index looks like for Strata on its own. And on the right-hand side, you can see that same affordability index for home insurance. And you can see that consistently the affordability index for Strata is significantly better than it is for home. So the average income you'll see on the left table is a little bit lower than the average household income on the right, simply because people living or owning strata tend to have slightly lower incomes than people owning standalone homes. But the strata insurance premium is also significantly lower than the home insurance premium. So the affordability index comes up with a better number when you're looking at strata. But that does beg the question, if strata is so affordable, why are we all dialing into a conversation about strata insurance affordability? And more pertinently, I guess, why are your clients and your customers telling you about affordability concerns if actually there's no affordability pressure anywhere? And I think the reason for that is because there is still affordability pressure. So I don't want to suggest that there's no affordability concerns. On average, the affordability picture looks pretty good, but there are still affordability concerns coming through. And I think there are three reasons that that affordability pressure comes through. So the first one, I think, is illustrated well by the McDonald's soft serve. Imagine many of you can remember a time, a beautiful time, when the McDonald's soft serve was advertised as still only 30 cents. And it was certainly a bargain at that price. But if you've been to McDonald's recently, you'll notice that there's been some pretty significant price increases, and it's now sitting at $1.15 for a soft serve. And the reason I use the soft serve as an example is that prices have gone up rapidly. $1.15 is still not going to break the bank for me to go and buy a soft serve. It's certainly a lot cheaper than going to buy a coffee. But the fact that it used to be 30 cents not that long ago makes me a bit grumpy every time that I pay $1.15, because the price has increased really rapidly. And we've obviously had some very rapid price increases in strata as well. The second reason is that, as I've said, everything that we've looked at so far has been an average. And so when we're bringing together premiums and income, it's an average premium, and it's also an average income. But even within a single strata complex, you have a whole variety of different incomes for different lot owners, and you also have very different premiums within a region for different complexes. So the affordability picture looks good on average, but that doesn't mean there aren't still some people that would have a very different affordability index if you calculated it for them personally. And some people do pay a lot more than others. The final reason I think that affordability is worth talking about is that what we've based the analysis on so far is the actual premiums being charged. But if the premium might be made a little bit lower by excluding relevant cover, then is it really sort of adequate if affordability is only achieved by taking out cover that would be relevant and necessary? So obviously we want to make sure that there's an insurance market where people can not only get affordable prices, but for that affordable price, they can get all of the cover that they need. So I'll start by looking at some of the price increases that we've seen over the last few years. So this slide shows you the change in median premium over the last 5 years. Now, the maps on the right-hand side are looking again at the major areas where strata is prevalent and color coding by postcode how big an increase each postcode has received. So the red is areas that have had their premium more than double over the last 5 years, and the green is areas where there's been either reductions for the light green or more moderate increases for the slightly darker green. And you can see that it doesn't matter which region you're in, there's quite a bit of red. And if it's not red, it's probably orange. So there's been very big increases in strata insurance premiums over the last 5 years, and that's been felt more or less everywhere. And over the last 5 years, the median premium has increased by 82%, which is equivalent to around 13% per annum. Now, as I share big premium increases, I think it is worth just touching on briefly how that story looks very different if you're in Northern Australia versus Southern Australia in the last year. The cyclone pool has come on and has significantly reduced premiums for Northern Australia. And so you can see Brisbane, Gold Coast, Perth have all really benefited from that in the last year. So give you an example, the average rate change on renewal was minus 12% for Queensland in the last year on the back of those savings that the cyclone pool has been able to deliver. So prices have been going up, but they have moderated in the last year as a result of the cyclone pool for Northern Australia. But I want to have a look at why prices have gone up so fast. And to do that, I want to take you through this graph. So what this graph is showing is a premium per dollar of sum insured. That's the red line. And then we've got a couple of inflation numbers in the blue and green lines. So CPI, that's the dotted blue line. It's probably the best known measure of inflation. Certainly if someone's on the news talking about inflation being X, they're probably talking about CPI, which is the Consumer Price Index. And what that does is it takes a bundle of things that a typical consumer might buy. So it has a bit of petrol, a bit of electricity, a bit of groceries, and it looks at how much it costs to buy that same set of goods now compared to what that set of goods cost 6 months ago or 12 months ago or whatever the time period that's being examined. Now, that is obviously very useful to get an understanding of inflation in the economy, but when you're in the business of building and or repairing damage to buildings, knowing how much grocery prices have changed is not really the relevant question. And what we find is that that green line, the construction price inputs, tracks our claims inflation much more closely. So construction price inputs is a similar concept, but rather than looking at how much it costs to have some groceries and some petrol and some electricity, it's looking at how much it costs to buy the bundle of the things that you would need to build a house. So you can see that up until 2021, the blue line was sometimes higher than the green line, and sometimes the green line was higher than the blue line. But then mid-2021, all of a sudden, CPI went up enormously and it got to just over 7%. You probably would be familiar with that number. But the green line shot up to 17.3% at its peak. So that's the input cost pressure that as an insurer, we've been having to keep up with because our prices need to cover the cost of repairing buildings, and repairing buildings has rapidly got a whole lot more expensive. Now, if I show that same information but on a different scale, so it's the exact same data being shown in this graph, but now I'm showing it as an index. So saying if your bundle of construction inputs cost you $1 in 2010, how much would it cost at each of the other years in the graph? Or if your premium for your premium for your strata was $1 in 2010, how much is your premium now? And you can see that from 2010 to 2016, the red line shot off above inflation. Then mid-2015 through to sort of early 2021, it was the other way around and the red line was well and truly under. But now they're coming back to be in alignment as of sort of mid-2023. So what story does that tell? It says that there was this period where price increases in strata were in excess of inflation, and there are various reasons why that happened. But then there was a hotly contested market in sort of mid-2015 for a little while, and prices fell through the floor, and that was a great time to be an insurance buyer because your premium was not keeping up with inflation. It was effectively too cheap. And when I say too cheap, the evidence for that is that players all exited the market around that time. So they came in there was lots of competition driving the price down, but then insurers were making big losses that they couldn't sustain because they in the market, they need to deliver returns, and if they're making big losses consistently, then it's not a market that they can play in. And then we've been basically playing catch up since then to get back up to that inflation line. And as of fairly recently, the red line has caught back up to that green line. And the good news is that that red line is now plateauing alongside the green line. So looking forward, the good thing is that that big spike we saw in construction price inputs has leveled off, and now there's much less inflation coming through construction prices. And if your insurer has done the work to catch you back up to inflation and get that price where it needs to be, then that price should be starting to level off as well. So had this really big period of heavy price increases, and that certainly creates affordability pressures. But the inflation that's been driving a lot of that is plateauing. And so that should mean that there's some good news ahead on price increases. Now, the second reason that I suggested that it's still relevant to talk about insurance affordability is that the analysis that was presented at the beginning was based on average premiums, but not everyone gets to pay an average premium. So the average might be $954 per lot, but the highest 20% of premiums are paying over $1,500 per lot, and the bottom 20% are only paying closer to $500 per lot. So there's a fair bit of variation in those premiums, even though the average is 954. Obviously, if you're paying 500, you're not complaining, but if you're at the $1,500 end, that's likely to be the area where affordability pressures are much more prevalent. So why is that? Well, I want to draw your attention to that green quote on the left-hand side of the screen, which says your premium is based on our prediction of next year's claims for your property. There are two things in that are very relevant. First thing is that it's based on next year's claims. So sometimes I think people think that when you have a claim, your premium goes up to kind of recoup the cost of that claim and make sure that that money is eventually clawed back. That's not how we price insurance. So we're pricing insurance looking at what claims we think you're going to have next year. And we're just trying to set a premium that most accurately reflects that. So it's based on next year. The second thing is it's based on your property. And that's something that as an industry, we've got better and better at doing. And CHU spent a lot of time trying to optimize our premium so that it's reflecting the true risk that each building presents. But that means that the price is not just an average for a big area or a big region. It's tailored specifically to the characteristics of your building. So what we're doing, setting a premium, it's based on what we think the claims are going to be next year, and it's that expectation of claims is based on the specific attributes of your building. So if you do find yourself paying a big insurance premium, I think the first question to be asking yourself is your apartment worth $100 million? Why do I say that? Well, a quick Google search shows me that this is the most expensive apartment in Australia currently, or at least that's the most expensive one I could find. This is in Barangaroo. The penthouse there sets you back $100 million. Why do I point that out? Well, $100 million might be a stupid number, but it's also, we're not going to insure that apartment for $954. And it does get to the most basic level of why some people pay higher premiums than others, is that some people have more valuable apartments than others. So if your sum insured for your lot is higher, then you're going to end up paying a higher premium. If your sum insured for your lot is lower, you're going to end up paying a lower premium. That's just the basics of the more that we insure, the more you end up paying. Now, this graph shows you what that looks like, where along the horizontal axis, I've got the sum insured per lot, and the vertical axis is showing the price. So the solid blue line, that's showing the average premium that you end up paying. But what's interesting in this graph is the shaded area. What that shows is a typical range. So certainly not everyone pays the average. The average does go up as your sum insured for a given lot goes up, but there is quite a bit of variation around that average, even for the same sum insured. So what I want to do is have a look at some of the things that can drive that variation. First thing I want to look at is defects. So this graph is exactly the same as the graph that was on the previous slide. All I've done is swap out the blue line that was going through the middle and showing the average to now show a green line and a red line. The green line shows the average premium if you don't have defects on your apartment, and the red line shows your average premium if you do have defects. And you can see that on average, policies with defects pay 17% more than policies without defects. Now, why is that? Well, obviously, if you have defects with your in your apartment, that increases the likelihood of those, yes, very rare, but when they do happen, very extreme or more catastrophic claims that could come through. And as an insurer, we need to be collecting premium to cover the risk of those big claims coming through. So we need to collect more premium in respect of that. Now, there's plenty of reasons to fix defects, and most of those reasons have nothing to do with price. But in addition, I guess the takeaway to have here is that each year that your apartment has defects, you'll be paying more for your insurance. Now, on average, that's 17%, obviously dependent on type of defect. That might be much higher than that, or it might be lower than that. But regardless of the type of defect, if there are defects, you will be paying more. And so the best thing that you can do is get on with fixing those defects, to take away that additional risk. And benefit one is you take away the additional risk, which is primarily, or a big part of that is human risk. So that's the most important reason to be fixing them. But the second benefit is that you will then get rewarded with lower insurance premiums as well. Another factor that can mean that you pay more than the average is if you've had claims. So if you have had a claim in the last year, you're more than twice as likely to have a claim next year. And that's probably the missing link a lot of the time when thinking about claims leading to higher insurance premiums. I said just before that we're not trying to recoup the cost of the claim, and that's absolutely true. But at the same time, depending on the type of claim, if you have had claims in the past, that can inform your likelihood to have a claim in the future. And you can imagine sort of a water damage claim is where this is most prevalent. If you have a water damage claim in 1 year, then, well, the claim might end up fixing whatever caused that particular sort of water leak to come through. It does tell you something about the building, the location, the other characteristics, and it's quite likely that even if you've fixed that particular source of water entry, there'll be another source of water entry that comes along in the future. So having had water damage claims does make you more likely to have them in future. The good news there, though, is that if you haven't had water damage claims, or if you haven't had claims in your history, then our premium algorithm will also actively recognize and reward you for that and offer you a lower premium. Final thing I want to look at is location, and this more than anything else is what drives you to be getting a premium that's at the top end of the range, or a premium at the bottom end of the range. So we've got this same graph there as before. The green line is now showing areas with low peril risk, and the red line is showing areas with high peril risk. Now, perils are just insurance way of thinking about what bad weather could come your way. So when I say peril risk, I'm thinking, are you likely to be impacted by hailstorms, by flooding, by cyclones, by bushfires, that kind of thing? If you're at low likelihood of all of those things, you're in the green line. If you're at high likelihood of any one of those things, you're the red line. And you can see that the median price per lot is 40% higher for properties with high peril risk. Now, to put that into context, here is an example of flood and how we look at flood risk. So CHU has spent quite a bit of time and money trying to work out at the very specific granular location level how likely it is that a particular building will be subject to each of the different bad weather events that can come and impact a building. So on this map, all of the little circles there are showing our assessment of flood risk for that location. So the green, that's showing areas with relatively low flood risk, and the red is showing areas with relatively high flood risk. Now, there's nowhere in this particular map in Victoria that does have very high flood risk, but the scale is still true that if you're closer to the river, you've got higher flood risk. If you're further from the river, you've got lower flood risk. Now, sometimes it's obvious like that. Other times it's not quite so obvious because these models are accounting for a lot more than just proximity to the river. But certainly the assessment that we make of your flood risk then determines the premium that you pay for flood. And you're probably familiar with the fact that we've been sort of pricing as an insurance industry. The industry's been pricing flood insurance in this kind of way since around 2010 when the Brisbane floods came through. But what you might not know is that we do the same thing for all of the other bad weather that can come through as well. So this slide shows you what that same rating looks like for bushfire risk in Port Macquarie and for hailstorm risk in Rockingham. I'll explain that bushfire graph a little bit more because I think that's really helpful for understanding how this can create affordability pressure. So that bushfire risk in Port Macquarie, you can see the majority of Port Macquarie has got green circles. That's the dominant colour in that map. But then closer to the vegetation, you've got some red circles. Now, again, that fire model is not just thinking about proximity to vegetation, but it's thinking about things like prevailing wind directions, separation between vegetation and properties with roads and things that might be able to create a fire break. It's thinking about type of vegetation and a whole lot of other factors. But out of that modelling, you get this answer that most of Port Macquarie's green circles, and then there's a smaller number of properties that are those red circles. Now, what that means is that if you imagine before we could do this, what price people would be paying for bushfire, what we would do as an insurer is say, well, we know there are some properties in the region with bushfire risk. So if we charge everyone $20 in their premium to cover that, then collectively, if everyone pays $20, we'll collect enough to be able to cover the bushfire risk for those smaller number of properties that do have more material bushfire risk. What we can do now that we've got this better estimation and assessment of risk is that we can say, if you're a green circle, you don't actually have any exposure to bushfire risk. And so rather than paying $20, you pay $0. So good news, you get $20 back on your premium. But on the other hand, if you're a red circle, rather than paying $20, because we know that you do have significant bushfire exposure, you might be paying $10,000. So bad news, because your premium's gone up from 20 to 10,000. So what that means is that if you are in those areas that are red circles and your building is particularly prone to some of these bad weather events, then your far more likely to be facing affordability pressures to buy your insurance. But it's actually good news for the majority, because you can see most of Port Macquarie, and indeed most of any area, is concentrated with green circles. So for the majority of customers, there's a benefit, but for those customers that are now paying a fairer or a truer price for the risk of their particular building, they can be getting much more heavy premium increases and much higher premiums quoted, because they do have that exposure to the bad weather. So that is a big driver of why some people end up paying significantly more than others, and can explain why even within a particular region or a particular pocket, affordability can look good on average, but still have some real challenges for some apartment owners. Final thing I want to talk about in terms of what creates affordability pressure is this availability question, because it's all well and good being able to have an affordable premium, but as I said earlier, if your premium is affordable but doesn't cover you for what you need coverage on, then it's not the most useful premium that it could be. And flood insurance is a pretty good example of that. So you could look at these numbers, and I know there are a few numbers on this slide, but could look at these numbers and say that flood insurance is working really well. We've got 89% of policies that have flood cover in the portfolio. So most people are successfully getting the flood insurance cover that they need. But if you break that down into the green circles and the red circles, you can see that while 89% of policies do include flood cover, there's only a 15% take-up rate amongst the 13% of policies that are likely to flood. So there's a good proportion of the portfolio that are getting flood cover, but if you're likely to have a flood, then there's a very low take-up rate, either because as an insurer it's not offered, or because it is offered but the premium is too high to make it affordable. So there's certainly still more work to do in that area. And it's not just flooding, it's also claims history, or if you're too far north, if you've got defects, there are plenty of reasons why your premium could be unaffordable, or why coverage might not be offered in the first place. So just to briefly touch on what we can do about these issues, I think that I've got 3 things here. 2 of them are very much just short-term band-aid fixes, which is choosing a bigger excess and choosing less comprehensive cover. If you do find that the premiums that you're getting are unaffordable and you're looking for premium relief, then choosing a bigger excess will lead to a lower upfront premium, or choosing less comprehensive cover will similarly reduce your upfront premium. But neither of them really get to the core of how do we make sure that people are getting appropriate cover, and that appropriate cover means an excess at the rate that they want to take it on at, as well as cover that covers them for the risks that they face. And the way that we get to there is really only by improving building resilience. So what I mean by that is that if we're changing excesses or choosing different cover, we're really just changing whether it's the lot owners paying for the damage or whether it's the insurer paying for the damage. But while someone's paying for the damage, be it a lot owner directly or an insurer after having collected premiums from the lot owner, if someone's paying for it, that cost is still there. And so the affordability pressure is still going to be there one way or another. What we need to make sure is that no one ends up having to pay for some of this stuff. And the way we do that is we improve building resilience, because if we do that, then the weather might roll through and the storm might come. But if the storm comes and the building is still holding up and doesn't leak and doesn't have damaged roof and doesn't sort of incur damage, then no one needs to pay for that damage. And so insurance premiums can be made lower. So that's not something that as an insurer we can do on our own. That's not something that as a strata manager or as a broker you can do on your own. But I think that's the only way that we get to a real long-term solution. If governments are working with builders to make sure things are built well, if strata managers and brokers are making sure that maintenance and things like that are done so that buildings are remaining as resilient as possible, and if when we're fixing things, we're making sure we fix them well, then collectively that's how we take some of the cost out and make sure that the product is available and affordable. So to conclude, 2 takeaways from today. You're going to remember 2 things. The first thing to remember is that strata insurance is probably more affordable than you thought. Going back to the very beginning, most of you were thinking that $1,000 to $1,500 band is both reasonable and what people are currently paying. The median premium is actually $954 per lot, so a little bit more affordable than you probably thought. And the other takeaway is that rapid price rises will slow down, and you should already be seeing that at the moment. So I'll move over to any questions that might have been sent through.
Yes, we do have some questions. We might just have time for 1 or 2. Defects lead to much higher prices. How do you make sure prices reduce when defects are fixed?
So that's really just making sure that when we're notified of defects, we're also notified of the fact that defects are coming off. And when we're doing the underwriting, if we know that defects have been removed, then we'll make sure that we reset the premium and take off any loadings that have been put in there for the defects.
You mentioned these red circles are much more expensive due to their location. Do you charge a different price for a low-lying set of townhouses beside a river versus a 10-story building beside the same river?
Yes, we do. So I think the core of that question is it just about location or is it about the building as well? And we're considering both. So those maps that I had up on screen were, well, the location, is the location likely or unlikely to have bad weather impact it? But when we're setting a price, we're thinking about not just location, but also the characteristics of the building. So if you are a tall 10-story building, then we're certainly recognizing that level 1 might flood, but level 10 is far less likely to flood, and pricing accordingly for that.
Great. Well, I think that's all we will probably have time for today. So thank you so much, David, and thank you everyone for joining us today. Certificates will be sent out within the next 7 business days. So yeah, I hope everyone has a great rest of their day and week, and thanks for joining.